Crypto trading strategies, maximizing profits in a volatile market. With cryptocurrencies like Bitcoin, BTC, rising exponentially in value, crypto investors will benefit from having a backup plan and thinking about what to do with their cryptocurrency earnings. Wise investors know they should not hold on to cryptocurrencies for too long at the risk of a big correction wiping out their gains. Therefore, it's always good to have a solid plan about what one will do after a big crypto win. It's tempting to spend money on a car or some other luxury purchase, which might be justifiable to a certain extent. However, it's also important to remember that these assets, cars, luxury bags, clothing, etc., tend to depreciate over time. 1. Research and analysis. In a volatile market, staying informed is crucial. Engage in thorough research and analysis to understand the latest news, trends, and developments in the cryptocurrency market. Stay updated on regulatory changes, technological advancements, and market sentiment. By staying informed, you can make more informed decisions about which cryptocurrencies to trade and when to enter or exit positions. 2. Technical analysis. Technical analysis involves using historical price and volume data to identify patterns, trends, and potential trading opportunities. Traders use various tools and indicators to analyze price charts and make predictions about future price movements. Moving averages, RSI, and Bollinger Bands are popular technical indicators. By using technical analysis, traders aim to spot favorable entry and exit points for their trades. 3. Risk management. Managing risk is crucial when trading in a volatile market. Implementing a solid risk management strategy can help protect your capital. One key aspect of risk management is setting stop-loss orders. These orders automatically sell a cryptocurrency if its price reaches a specified level, limiting potential losses. Additionally, employing position sizing techniques, such as determining the percentage of your portfolio or a fixed dollar amount to invest in each trade, can help ensure you don't overexpose yourself to any single trade. 4. Diversification. Diversification is the practice of spreading your investments across different cryptocurrencies. By investing in a variety of cryptocurrencies with different market caps, use cases, and risk profiles, you can reduce the impact of volatility on your portfolio. Diversification helps mitigate the risk of any individual cryptocurrency underperforming, as gains in some assets may offset losses in others. It's important to research and select cryptocurrencies that align with your investment goals and risk tolerance. By incorporating these strategies into your crypto trading approach, you can improve your chances of maximizing profits in a volatile market. However, it's essential to remember that trading cryptocurrencies carries inherent risks, and it's advisable to educate yourself, practice with small investments, and seek guidance from financial professionals before making any trading decisions. 5. Trend following. Trend following is a strategy that involves identifying and trading in the direction of prevailing trends in the crypto market. Traders using this strategy aim to capitalize on the momentum of trending cryptocurrencies. By buying cryptocurrencies in uptrends and selling or shorting those in downtrends, traders attempt to profit from the continuation of existing price trends. This strategy requires careful analysis of price charts, trend indicators, and confirmation of trend reversals before adjusting positions. 6. Breakout trading. Breakout trading involves identifying key support and resistance levels and taking positions when the price breaks through these levels. Breakouts are seen as potential signals of a new trend forming. Traders typically wait for confirmation through increased volume and use technical indicators to assess the strength of the breakout. By entering positions during breakouts, traders aim to capture significant price movements and ride the momentum of the newly established trend. 7. Scalping. Scalping is a short-term trading strategy focused on profiting from small price fluctuations within a day. Scalpers make multiple trades, aiming to accumulate small gains that add up over time. This strategy requires swift decision-making, disciplined risk management, and a reliable trading platform with low fees and fast order execution. Scalpers often rely on technical analysis, chart patterns, and real-time market data to identify short-term opportunities. At last, don't forget to subscribe our channel.